In Part B of Chapter 14's video lecture on accounting and financial statements, we're talking about the liquidity ratios, ratios that measure the speed which a company can turn its assets into cash to meet short-term debt. These things, such as high liquidity ratios, may satisfy a creditor's need for safety, but may indicate the company is not using its current assets efficiently. In addition to that, liquidity ratios are best examined in conjunction with asset utilization ratios because high turnover ratios imply cash is flowing through very quickly, which means this may be a management issue you need to address. Now, the current ratio is also an opportunity for you to look at how well the company is performing. Our current ratio is also called an asset test. It's basically a far more opportunity to look at how do you look at current assets divided by current liabilities. And there's an example there. So all of these have examples of Microsoft and get pretty complicated, but high level information is that current ratio is current assets divided by your current liabilities. Now, the quick ratio asset test is basically a really good measure of liquidity that eliminates inventory. It means to say, how liquid is your company? Can you get to cash pretty quickly, is what this tells you. And the asset test is a good way to measure whether or not a company can meet its financial obligations without selling all its inventory. So think about if you have a shoe store and you're trying to get money to buy more shoe racks. You don't want to sell all your shoes in order to get the money to buy the rack. So you need an ability to have a quick ratio that tells you that information without having to sell all your inventory. Debt utilization ratio. So this is on page 456. It's ratios that measure how much debt an organization is, or how much they have, relative to other sources of cash, such as owner's equity. Debt financing is riskier than equity, and it demands a monthly payment regardless of profitability. So you have to pay this back no matter what. It also has it where its recession affects heavily indebted companies far more than those financed through equity. And then companies tend to keep debt to asset levels below 50%. So you want to look at your debt utilization ratio because it provides information on how much debt an organization has relative to other types of capital. There's another conversational point here that I wanted to address, debt to total asset ratio. It's a ratio indicating how much of the firm is financed by debt and how much is by owner's equity. Remember I mentioned owner's equity is how much money the owner has put in. Debt is how much they finance to be able to get that money into the company. Time interest earned ratio is operating income divided by expenses. Now it also has another example of how Microsoft, there again, is a really great company that shows you that these ratios are real money or real opportunities to know about what's happening in the company internally. Diluted earnings per share. Now you've probably heard this terminology before, more so here, earnings per share. It's the net income or the profit divided by the number of stock shares outstanding. So it tells you that that's an important number to know for sure of because it's important because it changes often and is based on what's going on in the economy and it determines an overall firm's stock price. So you want to know what the earnings per share is so you can have a familiarity with the company and how well they're doing. Per share data is data used by investors to compare the performance of one company with another company when you're thinking about what's equal. So you have to have some sort of formulations that basically talks about how solvent is the company. Dividends per share. I love dividends per share. These are paid by the corporation to the stockholders for each share that's owned. The payment is typically made from earnings after the taxes by the corporation and is provided to the stockholders. Thus, dividends result in double taxation. So the corporation pays taxes on its earnings and then the stockholder pays taxes on the dividends. So it talks about this, but you do still want dividends per share if you can get those. Now this gives you the last actual slide we'll talk about. Basically, there's the importance of integrity in accounting. The recent financial crisis and the recession showed another example of failure in accounting reporting. It's important that our numbers stack up and we make sure we hire good accounting firms with good accounting practices. Many firms attempted to exploit loopholes, and that's what the issue came in because these loopholes were being exploited. You want transparency and accuracy in reporting revenue numbers and income to investors. The end. Thank you.